So let's talk about minor pairs. We just talked about major pair. When we talk about minor pairs are, you also call them cross pairs. Call them cross pairs. What does that mean? It means that there are pairs that do not include the dollar. They don't include the dollar, but you have at least one of the top. We just talked about the top 5 major currencies, right? Where you have JPY, which is Japanese yen, British pound, or the euro. It has one of these, but not the dollar. So when you combine the euro with GBP, that is a minor pair. Okay, because the euro and GBP are one of the top economies, but it doesn't include the dollar. The only thing that makes a pair a major pair is that it includes a major economy merged with the dollar or paired with the dollar, right? So Euro GBP, Euro CHF, you can see these examples here. All these examples are cross currency pairs or minor pairs. Okay, cross pairs actually a better way because we do not want to use minor. Right, good. So you have the euro, you have JPY, GBP, CAD, AUD, SZD, and when you combine these pairs together, you have your minor pairs. Then we have exotic pairs. Exotic pairs are made up of a major currency that is paired with a developing economy, the currency of a developing economy, or the currency of a smaller economy. Like when you bring the US dollar and the ZAR, right? When you bring the US dollar and the ZAR, right? This is a combination of the dollar, which is a major pair, but combined with the ZAR, which is and that makes it an exotic pair because the ZAR itself is that of an emerging economy, right? So let's move on from that. Well, when you're talking about trading currencies, what are the advantages? What are the advantages of trading currencies? Number one is because of the number of persons, because you have so many persons trading, there's high liquidity. High liquidity means that transactions can be done quickly, right? It's very different from the way you go to the market. You have to go to the market, buy and come. And this one, from anywhere, you can actually trade, make immediate profit, right? You can make immediate profit, and the transaction cost or the spread are very low because of a lot of buyers and sellers in the market, right? The cost of trading is very low, like I said, and then the profit potential is amazing in the sense that you can make profit from both rising and falling markets. You can make profit both from rising and falling market. And then because you have a lot of people trading this, you don't have one single person who can control the market. Okay, you don't have one single person who can control the market, which means that you do not have manipulation. It's hard for you to have one single body that manipulates because you have so many persons and so many volumes in the market at every point in time. Now let's talk about commodities. We just talked about currencies. Commodities are basic goods. They are used in commerce. We use them as input in production of other goods. That's commodities. So when we talk about commodities, they're not currencies, but they also retain value. They also carry value. Most of them are exchanged. Most of them are used for exportation. Most of them are used for creating other goods. Most of them are even raw materials and all the likes, right? But we classify them into 3 groups. We classify the currency into 3 groups. So we said major, minor, and exotic. Commodities are also classified into 3 groups. We have metals, we have energies, we have agricultural produce. When we talk about metals, we're talking about commodities like gold, like copper, like silver, like platinum, right? Then when we talk about energy, when we talk about commodities like energy, that's where we refer to crude oil, we refer to heating oil, we refer to natural gas, gasoline, and all that, right? Then we talk of agricultural produce. That's where we talk of those cash crops, some of those cash crops, like corn, like wheat, like cocoa, like sugar. These are agricultural produce. So you can trade metals, gold, silver, palladium. You can trade energies, crude oil, natural gas, heating oil. You can also trade agricultural produce, which is the corn, the wheat, and all that, right? That is that about commodities. Let's talk about indices. Let's talk about indices. When we refer to indices, we're talking about indices refers to combined stocks. When we bring different stocks and we trade them as a particular unit, that is what indices is. That is what an index is. When we have different assets and we are trading them. Let me start with what stocks are. Normally, when companies want to increase their capital base, when they want to expand, they usually offer up shares, right? I believe that we would have bought shares at one time or the other, right? So this make up stock. Now, this stock, okay, we have Apple stocks, we have Facebook, we have, so many different stocks. Now, but when these stocks are combined and traded as one asset, when they're traded as one asset, right? At that point, that's what we refer to as an index, right? So when we take Apple, when we take Google, when we take Facebook, when we take, those different assets, we bring them together and we now trade them as US 30 or Dow Jones. That makes Dow Jones an index because it's a combination of, do you understand? It's a combination of different stocks. So an index is a combination of different stocks. And so you can see on the screen there, we have Dow Jones, we have S&P 500, we have NASDAQ. All these are made up of different individual stocks. Okay. Now, we've talked about what we are trading, what is tradable. The next thing is, what do I trade? What do I trade? Who am I trading with? Who exactly am I trading with? And that's what brings us to market participants. Market participants. Who are those persons who join me, who will be joining me to participate in the market? Well, we have central banks because this market is a market of volume. When a lot of volume is following a buy on Euro USD, for example, when a lot of volume is following a buy on Euro USD, you know that the price of Euro USD will begin to rise. When a high level of volume is pursuing a sell on gold, when the high level of volume is pursuing a sell on gold, you expect the price of gold or the value of gold to begin to fall. So we have central banks, these people participate in the market. We have government, we have investment corporations, we have businesses worldwide, and then we have retail traders just like you and I, right? Good. Now we have, apart from those that are trading, we have those that influence or things that influence this market. We have different things that influence this market, right? The first one is what? Political events. Political events happenings around the world, conflicts around developed nations. When you have that, if an economy is currently having an election, it will tell on the market. Okay, if there is war in a particular place, it will weaken the economy, tell in the market, right? If there's high inflation, it will weaken the market, right? So these things influence the market. Then we have key economic events like the GDP, the interest rate, the CPI, and all that. All those actually influence the markets. Then we have key monetary speeches by banks around the world, right? Bank around the world. So sometimes when we're talking about banks around the world, we're talking about central banks, right? We're talking about central banks. So you will see something like Jerome Powell, the head of the US Fed, okay, the chairperson or the chairman of the US Fed will come out and say one or two things, and the market will react to that. Okay, and that is how it usually works. So these things can influence the market. They can influence the market. They can change the direction of the market from up to down. They can change the direction of the market from down to up. It's very important that you keep in touch with what is going on with the market. It's very important that you keep in touch with those things influencing the market. Okay, now let's talk about market sessions. Remember how I said that this market is open 24 hours a day from Monday to Friday? It's open to different persons around the world. And that is why we have different sessions. Now, what does different session mean? If I say London session is from 8 to 9, it does not mean that only people from London can trade at that time. But what it just means is that that is the active time in London. That's the active time in London. So that you know, right? So we have different sessions. We have the London session. This particular stuff was given to us in GMT. So the London session is from 7 to 4. The New York session is from 12 to 9, from 12 to 9 or 12 to 8. And then the Sydney session is from 9 to around 4 a.m. And the Tokyo session is from 11 p.m. to around 7 a.m. or thereabouts. You can see that this is it. This is the Sydney session, this one in blue, but it goes back to this point here. Okay, so it happens from 9 all the way to 5. Okay, the Tokyo session starts from 11 all the way to what? To 7. Okay, now being that this is GMT, if you're using GMT plus 1, all you need to do is to add an hour each to all these dates. You understand? If your GMT is GMT plus 5, you add, 5 hours to this to actually get the correct trading time. Now, how do you trade? How do you trade? Okay, now you buy when you expect price to go up, you sell when you expect price to come down. You buy when you expect price to go up, you sell when you expect price to come down. You buy when you expect price to go up, you sell when you expect price to come down. Okay, so let's talk about that quickly. What does it mean? Now, another term for buy is long, and that term for sell is short. And that term for buy is long, and that term for sell is short. So we can say, I'm going long on this instrument. What does that mean? It means I'm buying that instrument. I'm going short on this particular instrument. What does that mean? It means I'm going down. I'm selling that particular instrument. Now, look at this image here. If we say, for instance, this green box is my entry point, right? See, this is my entry price, and this arrow is pointing up like this. But this place here, this green point is what I'm talking about. This green point shows where you enter the market. Oh, you want to buy? This is where you entered your buy. So it will alert you in form of some green broken lines, right? You can now place what we call take profit and stop loss. You can now place what we call take profit and stop loss. When we talk about take profit is a particular price zone that you want the system to close your trade automatically for you once it gets there. Okay, so say you're on a trade, a profitable trade, you expect it to get to a particular point, you could actually place a take profit. Once you get to that particular point, please close in profit. You can also set a stop loss. Once you get to this, once you made this level of losses, please close this particular place for me. I don't want to lose more than this. Okay, I don't want to lose more than this. It's very important that you understand how take profit and stop loss works. Take profit and stop loss works depending on whether a client or a trader is buying or selling. Depending on whether you are buying or you are selling, right? If you are buying, that means you're expecting price to go up, right? And if you're expecting price to go up, your take profit should be above where you enter the market. Your take profit should be above where you enter the market, just like this image on my left. And then your stop loss should be below where you enter the market. Your stop loss should be below where you enter the market. Now, if you're taking a sell instead, right? You should actually start by selling, right? Because you're expecting price to come down. So your take profit will be below your entry price. Your take profit in this case will be below your entry price. Why? Your stop loss will be above. Your stop loss will be above your entry price. Your stop loss will be above your entry price, right? So you see that take profit and stop loss change direction, right? Take profit and stop loss change direction based on what trade we are placing. If we are placing a buy, take profit is above, stop loss is below. If we are placing a sell, take profit is above. Sorry, take profit is below. If you're taking a sell, take profit is below, stop loss is what? Above. Okay, so that is that about how to trade. This is an example of the chart. The example of the chart. On this chart, we see that this particular instrument is doing what we call a downtrend, which is something we are going to talk about. It's doing a downtrend. In this downtrend, okay, if we are selling at this point, we are expecting price to come down. So this person entered this price at this place here, entry price line, this place. So what did he do? He entered a buy at that point. That means he's expecting price to go up. Since he's expecting price to go up, you can see that his take profit is at the top here. His take profit is at the top at that point. That's where his take profit is. At the point. And he wants to place his stop loss to be below that particular point. You understand? So that is how take profit and stop loss works. Now, let's talk about what the effects of a benefit, an effective trader is. What the effect of a successful trader is. What does trading do for you? Trading helps you to be very flexible. You can work from home or anywhere in the world. You can trade from home or anywhere in the world, right? Then you don't need boss, you don't need employees, you don't need inventory, office inventory. Oh, let me buy this. Oh, let me buy that. No, what you just need is your smartphone or your laptop and internet connection, making it very easy and very affordable, especially with overhead costs, and also increasing the profit potential for that person. Okay, increasing the profit potential. Even the MT4, the MT5, and any asset we are trading with, these assets usually help us with trading indicators. They usually help us with trading indicators so that you know what exactly what you are doing, right? You know exactly what you are doing. Then you can trade at your leisure. You can trade at your leisure, and I really hope that we can imbibe this. You can trade at your leisure, right? So when you're free, you can decide to trade. When you're free, you can decide to trade. So this is very, very important. This is very, very important. I believe that what we have done today, we have learned quite a lot from what we have asked. Or what we have taught. If you have any question, please just ask on the chat here. We'll do our best to attend to you. Thank you so much for your time. We'll be looking out for your question. Bye for now. See you in the next session.